Good morning, John Mulvihill here from Mulvihill Capital Management. Just wanted to provide an update to unit holders of the Mulvihill Premium Yield Fund for the month of January and really since inception in terms of how we've been doing in providing income to unit holders, lowering portfolio risk, and providing additional capital appreciation beyond that 5% yield target that we aim to achieve on a quarterly or an annual basis. And also look at some of the risks in the market. There's obviously a lot of macro headlines being thrown at the market right now. And we just wanted to sort of highlight some of the things that we think are important and how those views are reflected in the current positioning of the Mulvihill Premium Yield Fund portfolio. So just before we begin, quick disclosure slide for compliance purposes. When we brought out the Mulvihill Premium Yield Fund in November of 2019, we really had three distinct objectives in mind that we wanted to provide for unit holders at the time. First and foremost, generate the enhanced tax efficient yield in the portfolio through the option strategy, provide additional capital appreciation beyond that 5% annual yield target that we aim to achieve, and lower overall portfolio risk relative to the broader market. As we stand today, as of February 15th, the current NAV on MPY is $11.36. So, from an initial $10 NAV, we've been able to grow it pretty substantially, net of the distributions paid. So on top of that $11.36, we've returned over $1 in distributions, paying our eighth quarterly distribution last December. And all of this equals about a 10.7% annualized return since inception. And when you break it down into sort of the capital appreciation and income component, if you look at a 5% annual yield, we're delivering an additional sort of 5.7% above that yield target over the last 2+ years, sort of checking off those boxes of income and capital appreciation. So turning to the income generation within MPY, we paid our eighth consecutive quarterly distribution in December of last year, really providing a consistent income stream and yield alternative versus traditional equity and fixed income exposure, where we believe yield remains scarce and risks remain fairly elevated. Just to recall, the December distribution was raised to 14 cents per unit from 12.5 cents per unit, an increase of about 12%. And we raised the distribution really on the back of sort of two reasons. First and foremost, given the growth we have seen in the NAV, the yield for new investors who were coming in were receiving approximately 4.3%. So increasing the distribution to 14 cents brought that current yield back up to about 5% for investors. For investors that have been in since the inception of the fund and purchased it sort of at that initial $10 net asset value, that 14 cents quarterly distribution now equates to about a 5.6% yield on your book cost. The second reason is the distribution remains well funded. So if you look at the option premium and dividend income in the portfolio, we're earning well in excess of what we're paying out on a quarterly basis. And so the gold bars here in this chart just show you the quarterly sort of per unit option premium we're generating on a quarterly basis, and compares it to the dividends we've paid out in each of those quarters. So again, this idea of really earning the yield that we're paying out to investors. In terms of the tax treatment, obviously a very attractive feature of this product is the return of capital distributions investors receive. Much like 2020, where 100% of the distributions were return of capital, we anticipate that 2021 will have the same tax treatment. As we enter sort of our third calendar year, I guess, of MPY, there remains over $88 million still available in the capital loss tax pool. And if you recall, we started with 91 million back in 2019, and so over the last 2+ years, even with sort of strong returns and attractive income in the portfolio, we've only utilized about 3 million of that capital loss pool, and I think it gives a sense of sort of how long of a runway this return of capital distribution could last for investors that are in the fund today. So we've touched on the income and NAV growth component of the Mulvihill Premium Yield Fund. We'll turn now to the last objective around reducing risk. And we've put together a group of popular equity income alternatives, including dividend growth strategies, call writing strategies, REITs, as well as broader asset classes, the S&P TSX Composite to represent stocks, the Bloomberg Canada Aggregate Bond Index to represent fixed income. And the takeaway is pretty simplistic. Relative to this group of comps, the risk-adjusted performance of MPY, remains the most attractive. And when you start to dig a little deeper into the volatility via the standard deviation and the beta of the fund, you can see the level of risk reduction we've been able to achieve since inception, particularly versus dividend strategies where we've delivered a higher yield. We're able through this capital loss pool to deliver the distributions in a more favorable treatment from a tax perspective. And we've done so with comparable returns and approximately half the risk and lower beta than the Dividend Aristocrats Index in Canada. So that gives you a decent rundown on where we've been over the last 2 years and how we've done from a return, yield, and risk perspective. And I just want to turn our attention now to sort of what we're seeing in the market and where we think we're headed for the foreseeable future. And in our view, there have been three major macro risks dominating investors' attention so far in 2022. The first one being inflation. And the second one being, and kind of go hand in hand, the Federal Reserve and other central banks around the world about to embark on a tightening cycle, taking away that ultra accommodative monetary policy we've seen really since the financial crisis back in 2008. And when you look at a long-term relationship between inflation and the federal funds rate, you can see just how far behind the curve the Fed is. So the latest print on CPI year over year in the US was 7.5%. And you can see that, this is a chart going back to the 1950s that shows this fairly tight relationship and just how far behind the curve the Federal Reserve is, leading us to believe that they are likely going to have to tighten fairly aggressive starting in the next meeting in March. The third risk from a market perspective at the moment is the geopolitical risk and the situation in Russia and Ukraine. And I think really what's interesting about all three of these headlines to start the year is just how well positioned the Canadian market is from the standpoint that it's the composition of the TSX really benefits from rising inflation, higher interest rates, and geopolitical uncertainty. What I mean by that is the large weight in financials and bank stocks benefit from a higher yielding environment. The rising inflation that we're seeing and the situation in Ukraine benefit energy and materials sectors, particularly commodity-centric names and gold producers. And it's this financials, energy, and materials sector that make up a large component of the underlying S&P TSX composite. On top of these three risks, I believe there's one other that I don't think is getting necessarily the attention it deserves in the media, and that is that we're beginning to see the economic data roll over, particularly leading economic indicators in the U.S., which are flashing in caution to us in defensive portfolio positioning in that you're starting to see the benefits of the COVID response and the monetary policy that was thrown at the market, that really sort of fueled the returns over the last few years, beginning to come out of the market, and it's now starting to impact the data going forward. So I'm just going to follow up with a couple charts here, just visually, so you can see what we're looking at and why our sort of antennas are up, that this may be a time to decrease risk in the portfolio and really focus on defense. So from a macro perspective, one of our favorite indicators of where the economy is going and really where ultimately equity markets are headed is the ISM Manufacturing Index in the US. And the ISM is able to incorporate a number of different variables. There's new orders, which indicates demand, inventory, there's an employment component, there's a prices paid, which shows you inflation. So it gives you a read on a broad spectrum of economic data in the US, and really has a leading component to it in that it sort of signals ahead of time where GDP and the markets are potentially heading. And to get that point across, what we do here is just line up the ISM Manufacturing Index, which comes out at the beginning of each month, and look at it relative to the S&P 500 on a year-over-year basis. So you can see it's a pretty high correlation, as goes the ISM, goes the year-over-year return in the S&P 500. And one of the reasons we spend so much time trying to figure out the direction of the ISM and its subcomponents and what it is telling us at the moment. So to that point, the subcomponents of the ISM can offer a very useful gauge to the direction of the ISM. And what we're showing here is the ISM new orders component. So essentially just think of this like the demand in the US at the moment in the manufacturing sector. And if you advance this series 3 months, it gives you a pretty accurate gauge on the direction of the ISM in the months ahead. And so what you've seen recently is really the new orders in the blue here roll over and fall off a cliff, with the ISM starting to follow it down. And we believe that what you're going to see over the next few months is this gold line, the ISM, continue to track lower with the new orders component, which when you combine that with the chart on the previous slide, what that means is that the year-over-year change in the S&P 500 is going to continue to deteriorate. So, very important in this regard is that just because the year-over-year change in the S&P 500 is going down, it doesn't mean that it has to be negative. So, we're watching for a slowdown in the U.S. market, but it doesn't necessarily mean that we're automatically heading for a recession on the horizon. So if the message on the previous chart is indeed correct, where you have this slowdown in the new orders, which is set to weigh on the leading economic data, including the ISM in the US, ultimately this weighs on the fundamentals of the S&P 500 constituents. And what we're looking at here is both sales on a year-over-year basis and earnings estimates on a year-over-year basis, relative to the ISM, which we've advanced 6 months. So you're already seeing this ISM roll over, which we talked about on the previous slide, which the new orders is telling us is going to continue to go down. And the year-over-year change in sales on the S&P 500 has historically tracked pretty closely with this ISM Manufacturing Index. So really what the reading is telling us here for both sales and for earnings estimates on this slide is that a peak in the ISM, which is set to go down further, is going to ultimately find its way into the fundamentals of the S&P 500 in the way of slowing sales, lower earnings. You can put a operating margin chart here instead of earnings or revenues, and it shows you the same sort of message. And so when we see this sort of peak revenue, peak earnings estimates, peak operating margins, combined with what the underlying macro data is telling us in the form of higher inflation, which is going to pressure costs. It all sort of adds up that that earnings are set to slow, which isn't the greatest backdrop for a real strong bull market in 2022.
What does this mean in terms of positioning within the portfolio? So I think there's really one broad takeaway, and maybe a couple sort of satellite takeaways, but the broader takeaway is defense, whether it's defense on a sector positioning basis or defense on a factor positioning basis. And so here again, looking at the ISM, you can see the industrials relative to the staples sector. So as the blue line goes up, the industrials are outperforming staples, which typically occurs when the ISM is going up. And right now, what we're seeing as the ISM is rolling over, you're having staples outperform industrials as the line comes down, and we think that's set to continue here. So, we've gone from very minimal exposure in the staples, in fact, 0% exposure in the staples at points last year, to about 12% at the moment, and really in large cap, brand names. We currently own Coca-Cola, we own Procter and Gamble, names like that where we want to participate in the market, but we want to do so in a defensive manner away from sort of the technology and higher growth areas of the market and higher valuation areas of the market.
Ultimately, where this leaves us in terms of portfolio positioning, just to summarize what we're looking at here and currently positioned within the portfolio is that we're taking a barbell approach, as we often do. Couple of the highlights I would say, and I discussed sort of how Canada was built for this type of environment of rising rates and rising commodity prices due to inflation and geopolitical concerns is the weight in Canada in the portfolio is almost as high as it's ever been, and the weight in the U.S. is almost as low as it's ever been. And within the U.S. is really where we're focusing on that defensive portfolio positioning. So when we look at the economic data rollover in the U.S., we want to be more in staples and defensive areas of the market. Even within U.S. technology, which is more of sort of a cyclical, growthy sector, rather than owning some of the sort of higher beta semiconductor names, we're sticking with quality and balance sheet. So we'll own names like Apple. In terms of the Canadian side, we continue to be positioned in the Canadian financials and the Canadian energy names, particularly on the energy and the commodity side is where we're focusing a lot of the option-based strategies. So within Canadian energy and U.S. energy, you're getting very attractive vol in a trending market. So a great area to write puts and get a lot of premium in the door, and potentially have the opportunity to roll those a few times within the month. And one of the areas that we continue to look at, we've been on it for about 6 months now, but have had minimal exposure, just waiting for sort of the momentum to kick in, is the gold name. So certainly an area we've added to recently, but still nothing major. We do really like the setup there, but continue to monitor it and think that that's going to be potentially a terrific sort of asymmetric bet as investors play catch up in the space. Always happy to chat. jpm@mulvihill.com. Send me an email. We can set up a time to have a conversation, and look forward to hearing any thoughts or feedback. Thank you.